Welcome back. This morning, the import and export price index was released, and what we're going to see is a very close correlation between these indices, the relationship between the two indices and the dollar, the US dollar, which certainly has been very active as of late. Here we see on a month over month basis, the import price index was up 0.1% in red. In yellow, it's the year over year down 1.7%. Export price index up 0.7% month over month, year over year, down 4.1%. The import and export price index is published by the Bureau of Labor Statistics starting in year 2000 at a level of 100. So that's the baseline. Here we see in blue on a month over month basis the import price index and yellow export price index. Now, this is on a month over month basis. We can see we were negative for quite some time, but it's actually even more significant than that. We can see over time between around August of 22 through, just about 3 months ago, about June of this year, we saw negative reports across the board, meaning month over month declines on the import and export price index. The import price index measures the price of goods that are coming in from overseas. Export, conversely, is the price that that we charge to send goods overseas. On a year-over-year basis, in blue, we have the import price index, which has been negative, as well as the export price index. It looks like it's improving, though. It looks like the negative year-over-year reports are getting better. And take a look at a longer period of time. This goes back to 2021. We were positive for quite a long time until we really saw a depreciation with the emergence of the inverted bond curve in mid 22. That has changed, though. We are in negative territory this entire time during the ramp up of inflation, but it looks like the prices are rising. Still negative on a year over year basis, but rising. Well, here's the imports minus exports. I'm sorry, the exports minus imports. So, how much more we're charging for goods going overseas as opposed to how much we're paying for goods coming in. The yellow histogram bars show the Fed funds rates, and it seems that the ratio, and we want to see a high export to import ratio. Well, that depends. We want to see that for the dollar, but not necessarily for the stock market. We'll explain why. But in terms of inflation, we see the ramp up of interest rates starting mid last year. Now we see the export minus imports rising. In other words, inflation has changed the dynamic between exports and imports. Exports were able to charge more, because our inflation has made our goods more expensive. So that's probably why that's the case. Now, here we see in blue, it's the exports minus imports. Again, the blue line shows how much more we're charging to export our goods than we're paying to import our goods. And the blue line goes up at the same time that the yellow line, the S&P 500, goes down. You see, what's good for the dollar is not always good for the stock market in the sense that corporate earnings, our companies want to be able to buy goods cheaply, to buy raw materials cheaply. And when the exports goes up, well, our foreign consumers, the consumers overseas, can't afford as many American produced products. So as a result, our exports, the volume of exports goes down as our inflation makes them more expensive. So as a result, we see an inverse correlation. And as of late, what does this mean for all of us? The blue line is going up, which does not bode well for stock in the sense that exports going up versus imports, well, it means that the consumers consuming American goods from overseas are not able to afford as much, and therefore that could put a strain on U.S. corporate earnings. However, when we consider the dollar, here's a dollar Swissy. It's just a reflection of the dollar, and we can see the dollar Swiss in yellow versus exports minus imports. And we can see there's a very strong positive correlation in the sense that when exports go up, well, more foreign capital has to be converted, whether it's Canadian dollars or euros, pounds, whatever it may be, have to be converted into US dollars. Therefore, as the exports go up, well, they have to buy more US dollars, the dollar goes up. So to sum up, what we see here is a reversal in the trend, the medium-term trend. It looks like exports minus imports is going up. And as a result, historically, this does bode well for the dollar, but not necessarily for stocks. At least those stocks, if you're looking at our portfolios, look for those stocks with international exposure, which, I know is almost everything these days, but especially those big exporting S&P 500 companies. Those could, most definitely be affected by the ratio of exports to imports. We hope this has been helpful. We look forward to seeing you back soon.